Okay, ladies, gents, let's take a look at market structure. So first things first, what I'll do is kind of remove everything that isn't structure. So we'll remove sessions. We'll remove liquidity that's already removed. We'll remove order blocks. We'll remove fair value gaps. So inside the indicator in general, we have structure, we have sessions, we have some customizable features. We have the dashboard. I'll actually keep that on there. We have liquidity, order blocks, and fair value gaps with, again, some customization. So we're going to be diving into structure. So this is what it would look like if you had only the structure selected. You'll notice there are many highs, lows, internal lows, breaks, changes of character, whatever it is, but we're going to go through each thing individually. So you can open up your indicator. And the first thing and the most important thing that I want to talk about is swing structure. So we're going to remove, for now, internal structure, because to be quite frank with you, internal structure isn't something that I need as an indicator. It's not something that I really use, to be totally honest with you. But it is something that helps other people, as I've noticed. And I will still talk about it. And at the end, I'll also walk through my personal settings, as I told you. But for now, we'll just look at swing structure. So we have show swing structure. We have the break of structure labels, the change of character labels, the swing point labels. We'll actually remove the swing point labels. I think those are the higher highs. We don't need them. Swing level lines, we definitely want to see those. And unconfirmed levels, those are also important. So if you just have just those things selected, what you will see in here is your actual trend, your actual structure. Now, why this is important? First and foremost, this is built specifically on a set of rules that I have personally developed myself over an extended period of time. The big question that comes with something like market structure is, how do you make it objective and repeatable and rule-based, which is objectively repeatable? So many people get market structure wrong. Such a powerful concept, and yet so few people actually get it right. And the market and the industry is flooded with indicators on market structure. All I have to do is type market structure and you will see probably thousands of market structure indicators. So why is ours different? Why is it not just the same? Why don't I just use somebody else's? And the answer to that, let's say I turn this indicator on right here. The answer to that is quite simple. If we turn mine off, this is the type of market structure indicators that are out there on the market. Indicators that, simply put, make absolutely no sense whatsoever. This indicator here makes absolutely no sense whatsoever. I mean, this is a market structure break. What does that even mean? How is it a market structure break when there is a high and low in here? What constitutes a market structure break? Okay, well, why is this a market structure break? Why isn't this a market structure break then? Why? Why is this not a market structure break? Why is this a market structure break and this isn't? Why is this a market structure break? Why is this not one? Why is this not one? Why is this not one? These are the swing points. It makes no sense. And that's what you'll find with probably every market structure indicator that you'll find out there. Let's take a look at this person's. These are the most common ones. So now we'll remove yours and we'll look at this guy's. So again, another indicator. Okay, break of structure, change of character. How in the world is that a change of character? And then that's a change of character. And so what you'll quickly find, and unfortunately, we're talking about indicators that thousands of people are using that is completely ruining their trading. And the main reason for that is because these indicators are simply built by non-traders who want to sell a product. And hey, that's fine, each to their own. But as I said at the beginning, this is an indicator that I've built for myself, for my own trading. It was only agreed upon to share it with you guys when thinking it through. I've been using this indicator before it was published to you guys because It helps my analysis. And so what's different? It actually has rules in place. It doesn't just randomly break highs and lows that give you some theoretical change of character that simply make no sense, that would just lead you astray. You are better off just flipping a coin. Genuinely, you would be better off flipping a coin. If it lands on tails, my bias is bearish. If it lands on heads, my bias is bullish. And trading based off of that, you'd probably be more accurate. That's not even an exaggeration. Like, that's genuine, because it's just probabilities. Those types of indicators, they aren't built by traders for traders. They're just not. No one is using that. And if they are immensely unprofitable. I'll tell you that for free. And so this indicator is my indicator that's built by myself, for myself. Now, why have an indicator? Why do I decide to use one? Why don't I just do it myself? The time involved and the potential for human error. And so I developed a very specific set of repeatable rules that define whether something is a high, a low, a break, a not break, a change of character, etc., etc. And those rules have helped me and countless of my students make multiple hundreds of thousands of dollars in verified trading profits, because the indicator itself isn't the edge. The edge is the edge. The indicator is simply just a way to automate the analysis of the edge, which is primarily structural based. And so every break of structure you see in here, every change of character you see in here, follows a specific set of rules that I personally use, that has data built into them, that I use, that my edge is built upon. And this has been years of development. So we'll get into the kind of nitty-gritty details. As you can see in here, if you were looking at this price action, undoubtedly there are an infinite number of swing points on this price chart, but not all swing points are the same, right? Why are not all of these levels highs and all of these levels lows? Because it follows a specific set of rules, as I've explained to you, that I have tested over years and years of data with a very high degree of accuracy. And so most swing points are completely inefficient. And the question for you is just, if you trust me, then you trust me. And this indicator literally tells you your swing points, period. If I was to turn this off, for example, and you looked at this naked chart, first and foremost, where do you start? I don't know. Maybe you'd look at this, and maybe you'd say, okay, high, low, higher high, lower low, lower high, lower low, lower low. Da-da-dum. Maybe that would be your structure, right? Because how else would you define your structure? You'd be looking at all these different swing points. The problem is none of them are repeatable. They're all just trying to find some external high. And then the doubt comes in, because then you start asking yourself, well, what makes this a high and this not a high? What makes this a high and this not a high? What makes this a high and this not a high? Is this a high? Is this a high? Well, isn't this a high? What about this one? You don't know, because you don't have a repeatable rule in place that tells you what is a high and what is a low. And so you're just left with ultimately random analysis. That's what it ends up being in the end. In the end, it just ends up random analysis. And there are too many times that you get stuck in a situation where you don't know if something is actually a break of structure or actually a change of character, right? For example, let's just look here. If you were to look at this here, right? This is a high, this is a low, we break structure. Would you then not conclude that, okay, well, then that's a break of structure, then that's a change of character, so now we're bearish, now we're looking for shorts? And obviously that wouldn't play out, because this entire time we were actually bullish. And then you may conclude, well, this is a low, maybe this is the high, maybe we're bullish, maybe you're a long in here. No, we changed character down here. So we were actually bearish. So this is your entry point. This is your area to look for shorts. Okay, well, aren't they breaks of structure? No, they're not. Plain and simply, they're not. And then we change character. And so now the play is longs. And then we break structure and we change character again. And so again, in many cases, maybe you look at this and you go, okay, swing low, swing high, change of character, we're bullish. Okay, we're bullish. I'll try to long from here, fail. Long from here, fail. Long from here, great, fail. Long from here, great, fail. This entire time, the play was always shorts. shorts, shorts, break of structure, shorts. Again, still the high in here. Price comes up. These are your entries. These are entry triggers to go short. And then we change character. No longer is the bias short. The bias is now long. We change character. We pull back. Fair value gap. Longs. Pull back. Longs. This becomes the high. And again, the rules tell you this is the high, not this one. Now what happens to a lot of people see this random low in here and they define it as a change of character. So what would you be doing? Well, simply put, that's a change of character. I'm going to short the market. Fail, short the market, fail. When this entire time, the real move was after we break structure into fair value gap, we're longing from here. That's how you get caught on the wrong side of the market. And then many people would be looking at the same thing again. Let's say price pushes up to the highs, right? We're bullish. So I should long in here, fail, long in here, fail. The change of character comes here. The shorts are here. We break structure, shorts are here. We break structure, shorts are here. We break structure, yes, you would try and short and you would lose, which is completely a part of the game, obviously. That is the whole point of an edge. An edge is nothing more than a statistical expectancy over a period of time. Period. But the only way you can develop an edge and statistical expectancy is by having concrete rules that give you expectancy. Expectancy can only be created out of predictability. Something must be predictable for it to be long-term profitable. If it's random highs, random lows, no logic, you can't ever create expectancy. You will just get literally random, sheer random results. And so we change character. The pullback is the long. We break structure. The pullbacks are to go long. We break structure. The pullbacks are to go long. We break structure. Which leads us up to where we are right now, which is a pretty large range, and sometimes it happens. This is the low. We wick the low, not a change of character. We wick the low. And it's very simple. Some people would look at this, they'd see that it wicks the lows down here, and they would put it as a change of character, right? But that's pattern recognition. That's not logic at all. If something wicks below a level, it simply means that price did not accept lower prices. It's plain and simple. It's just logic. It's common sense. If I'm the only buyer in the market and you're the only seller in the market, and I simply do not accept to buy at your price, I either cannot buy or you cannot sell. Period. If price does not accept lower than a level, right? Price does not accept lower. It's not going to go lower. And you can see in here, we reach the level, we wick below, failed, we try again, failed, we try again, failed, we try again, failed. How could you categorize that as a change and try to then short the market? Wrong, 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 right? Price was always expected to trade higher from the back of this. That's why a wick should never be a break of structure or change of character, because a wick is literally implying a failed acceptance. And so that's structure. Structure is simply the external swing points of price coded on a specific set of rules that will tell you where is a low, where is a high, and what the bias is. This little thing in here gives you the idea of it on multiple time frames. So you can see here the H4 is bearish, the M15 is bullish, the M1 is bearish. Now maybe you don't use a 15-minute time frame, maybe use a 30-minute time frame. Doesn't change anything. Maybe use a 1-hour time frame. Doesn't change anything. Right? It's the same rules on different time frames. Consistency. You can see in here in the hourly time frame. You can see break structure, change character, change character, change character. Now this is a textbook manipulation reversal model. When price barely breaks and then barely breaks and then rallies through and then rallies through, this is an indication of liquidation. The good thing about this is that that's why we use multiple time frame analysis. Because again, plain and simple, let's say we were to we change character in here, right? So now we're bearish. There's your bearish order block, for example, and we absolutely rally straight through price. Do you think there is any way to get short in this move? Unless you're a fool. Of course there isn't. There's no lower time frame confirmation. Price runs straight through it. And then we change character. Now we're bullish. Do you think there is any way on a lower time frame for you to get long in this area? No, of course. Price just runs straight through it. That's the importance of multi-time frame analysis. So we might be bearish on the 1 hour, and when price gets to a level, we drop to a lower time frame to look for structure on that time frame to tell us that yes, price does accept this, and now we will continue lower. And so when we just run through, you won't see it. Now, take this for example. We change character, we come back up. What happens here? Acceptance. Price reaches a level, right? Bearish. We reach a level. We begin accepting a price. We shift, as you can see, the highs to the lows. The entry is right here. And we continue to the low. And so that's all that is. This is all that is. It's the same thing again here. You can see some people maybe look at, okay, price shifts bearish here. We got stopped out. Okay, no problem. Price is now shifted bullish, right? We got in. Oh, great. It worked. We're bullish again. Oh, wait. No, now we're bearish. Oh, wait. Now we're bullish again. You missed all the moves. The real move was here. This was the high. These are your longs, right? You probably get out of here. You'd wait. After this reversal, you don't then try and change anything. Price breaks. We're bullish. You still go long in here. This just becomes a liquidation. This is your move out. These are your levels, and you're gone. Because price was always bullish. And then this is a textbook reversal. We've been bullish for a very long period of time. When price goes from expansion, which is what this is, to contraction, which usually looks something like this. Typical reversal indication. And then we get the sell down, which is usually a lot more smoother. Same thing again, we break structure in here. Sell opportunities. Price comes back. What do we get? Acceptance. Confirmation. Acceptance. Confirmation. Pullback. And gone to target. So that's what you'll find what this structure indicator will do for you. It will basically give you your bias. And realistically, how I use it, I trade in direction of the bias 98% of the time. If structure is bullish, like this, we have a break of structure, we have a low down here, I am trying to be a buyer after we get some type of lower time frame confirmation. And I just want to play the bullish continuations that I know are probable to continue. In fact, let's just take a look at this. Let's go to the 1 hour time frame, right? Let's map out, let's say, 10 levels. So what we're seeing here is we have a high to a low, and we have a change of character. Sorry. So now we're bullish. So the first one, from high to low, gets a continuation. So we're bullish and we continue. There's one for pro trend. We break structure, we pull back, and we continue. There's another one, pro trend, right? We pull back, we get a break of structure in the direction of the trend, pro trend. Then we get a change of character, and we don't follow through. Then we get another change of character, we don't follow through. So that's 2 in favor for price takes a level and doesn't continue. However, this is where you must be contextually aware and understanding what's happening here. When price runs through aggressively like this and like this, there was no way you was ever going to trade in direction of the change of character. Price changed character to bearish. You was never going to be able to get in longs there. In shorts, price just would not give you an opportunity. So those are the incidences where you will find reversals. No problem. We change character, we're bearish. Does price continue? Yes. This is just the most recent price action. Okay, we're bearish. Do we pull back and continue? Yes, we pull back and continue. Okay, another one. Now we're bearish. Do we pull back and continue? No, we change character. And by the way, even still, the change of character itself is the reversal period. We change character. We become bullish. Do we pull back? Do we continue? Yes. So it's just probabilities. We can see here there are a total of 9 instances where structure was broken. 6 out of 9, which is more than 60%, around 63, 66% of the time. After price broke structure in a certain direction, it continued in that direction, giving you potential tradable setups. And even the situations where it didn't play out, still untradable situations. That's what this market structure indicator is here to do for you. That's its job. And when you understand the statistical probability, you understand that there's a 70% chance that we will probably get a continuation or that price will probably shift from here. Well, now that's something that you can build a trading model of. That's something that you can build expectancy of, because it's the same set of rules, the same principles that are reoccurring, not random left to chance models that you choose a high and you choose a low. You're not randomly choosing a high and randomly choosing a low. If you was to do something like that, it would look something more along the lines of this. So you would choose a low, cool. You would choose a high, cool. So we break the low and we come up, we put in a high, and then we continue. And then, for example, after that, we would come put in a low in here. We would put in a low in here. We would put in a high in here. These are just random highs and lows. And then price would break the highs, give you a reversal, break the lows, give you a reversal, break the highs. Then you'd have a new high, a new low. We'd break the highs, we'd break the lows. You'd have a new high and a new low. You'd break the lows, so you won't be able to trade the highs. This is all you could do just to identify the swings. Far less accurate. Not repeatable. So it's completely left down to random chance. And everything just becomes messy. And most of these, even these micro moves, they're untradeable for the most part, because there's not enough substance in their distances or their pullbacks. And so that's the swing structure. That's predominantly what's important in this structure indicator. You can also use the internal, and this will basically show you the internal structure. And like I said, this isn't something that I personally keep toggled, I'll be honest with you. But for some people, it's, valuable. And so if we wait for it to load, you can see something in here, for example, like we have it's still based on repeatable principles as well. We have a low and a high. Everything inside is internal. So we put in a low, we put in a high, we get an internal break of structure, so bearish internally until we eventually reach the target, but we're still bullish. So we still stay bullish. Then we have an internal change of character. And so for some people, maybe that's their confirmation in an external price leg that you're bullish. You wait for internal price movement. I prefer lower time frame confirmation as opposed to internal, but hey, whatever kind of floats your boat, I added it in there because it's still something that people find valuable. It's still something that can help you, to be honest with you. But to be frank, not something that I personally use, but play around with it, see if it's something that you like. So now we'll look at sessions.